Mic check. All right. Good morning, everyone. Great to be here with you this morning. Today is Thursday, February 18th. Welcome to this live intraday strategy webinar on SB Trade Desk. Good to be with you guys here this morning. David, Hussein, Mark, and Mark. Eileen, as always, David in the room. Thanks. Great to see you guys. Eileen says, good morning, Michael. Your webinars must see TV. Right on, Eileen. I like the enthusiasm. Cheers. Mark, good morning to you as well. So we just got the release of wholesale trade data from Canada, pretty much in line with expectations. So did the Philadelphia Fed Business Index, slightly better than expected. More importantly, the weekly initial jobs claims, a split decision here. So you got a little bit better on the initial jobs claims, coming in slightly smaller than expected. Continuing claims slightly larger than expected. You're seeing the dollar largely hold that range-bound action that we've been seeing in overnight trade. So we have a lot to go over today. I am primarily focused on the dollar crosses. If you guys have questions in the exotic crosses, feel free to throw them down on the message board. There hasn't been a lot to talk about. If you notice, I didn't really give much last night. All we were working with was the Aussie and the Kiwi. Aussie, we took a couple of longs that worked out pretty well. Kiwi, I got stopped out on a short position. I'll show you that. And the dollar index is seemingly turning or looking like it's turning ahead of resistance. So if you guys remember on Monday, the bearish invalidation level for the dollar index was 12,131 into 12,123. We talked about that yesterday. We turned right ahead of that. In fact, we probed just through that 200-day moving average before turning lower. So this is going to be our bearish invalidation level. I don't put it past the dollar to make another probe into that region before we turn lower. But broadly speaking, maintaining or looking for a rally here in the dollar to sell sub 12,131 here in the greenback. So the index pretty much where we left it yesterday, not much play on that side. Kiwi dollar was the one that gave us a little bit more of a stretch. Aussie dollar is holding the range, CAD yen holding the range, sterling dollar, it did close below 143, but we popped right back through in typical fashion with the sterling, so we'll talk about that. And the dollar Swiss holding within that median line formation, still looking for a rally there to sell. All right, let's jump right in. First things first, here's what the dollar performance looks like on the session as we get started. Pound, biggest performer today with a gain of 0.5%. Again, slid below that 143 level on the close, 140. 285, I believe, was the close before it ratcheted right up during European trade. The yen with a gain of 0.2%. Block seeing a pretty heavy day here. So the Aussie down 0.45, still holding within the confines of the opening range for the week. Really weak Aussie employment data last night. We'll go over that as well. Euro down 0.38% and Swissy with a loss of 0.26. Okay, let's jump right in. As always, feel free to throw out any questions or trade setups, guys, that you'd like to review. Okay, so first things first, let's go over the Kiwi dollar. Here is the Kiwi last night, and it was holding right into this resistance range. I noted that in the report yesterday. I was looking for short exposure. Now, as I wrote this report, I was actually already in the trade from earlier in the day. So we had to stop against that swing high that we made in New York trade. Obviously, it probed right through to catch this trend line support, former support, now resistance, and then it turned right back below. So we're still broadly holding that same area. Remember, the bearish invalidation level is still at the weekly opening range high. That hasn't changed. 66.77 is that key 618 retracement of the advance. You also have the 200-day moving average coming in at 66.73 at this point, and the former median line support, now resistance. So that's still going to be the objective opening range high. We're still looking lower below that region. Here's what Kiwi dollar looks like first on the daily, and then we'll go into the 30-minute. So again, just wanted to bring your attention to that 200-day moving average, the broader upper median line parallel for the broader formation here from the October and December highs, and former lower median line parallel support all right there, 66.77. It's still going to be our bearish invalidation level. Nice reaction to it. In fact, right after I got stopped out of that trade, about 30 minutes later, there was a beautiful trigger to the downside. So I hope some of you guys caught that one. Here's what it looks like on the 30-minute. Okay, so again, break of that confluence region of resistance. You saw that pop to the upside. Let me just snap these lines for you. Okay, and there's the move to the downside again, right back below 64.40, right again within the confines of that median line formation, and you got that trigger earlier in the session that puts you a little bit more on the downside. On its face, guys, what I do want to just really, put out there is that this thing is just set. It's still within the opening range. Here's your Monday, Tuesday stretch. Okay, so we don't have the validation to really press aggressive shorts at this point. I still like the downside. I still would rather prefer to sell rallies. At the end of the day, 66.77 is going to be our bearish invalidation level, any way you put it. Question here says, was in Kiwi dollar too soon? Also stopped out and then was a better entry, but I didn't see that. It was earlier at extreme and was divergence on the 30-minute and the 5-minute with the triggers, but no go. Same as the Euro Kiwi. We'll take a look at Euro Kiwi too. I see a lot of questions on that. I mean, here's Eileen. Here's what let me just show you what the scalp looked like on Kiwi dollar. All right, so the short trigger for the actual initiation or the actual entry on the trade was right here as momentum was coming back below the oversold level at 70. Okay, and this was heading right into resistance. So you came into that resistance region, pulled the trigger a little too early on this one with that break below 70 to the downside, no problem. We had a 25 pip stop on this one. On this stretch here, we just missed getting stopped out. We came back down. Okay, we are back. Sorry about that, guys. Where did I leave you? Where did I leave off? Okay, so the point being, the secondary trigger here was, again, like I said, the opportunity to really take advantage of the drop to the downside. I still don't want to be too aggressive because we're still within the range, and Aussie's still fueling that opening range as well. Got some really weak data. We'll look at that in a moment. When a pair stalls sideways for so long, is there a propensity to break the general direction of the main trend, or better just to wait for the breakout to see what it does then, like the Kiwi dollar before it broke to the upside? So Eileen, great question. And my performance or my trade yesterday was your answer to that. We sat in that for hours, right? We sat it pretty much for the entirety of the US session into the Asia Open. Okay, so for me, let me take a step back. Oh, this is a very good question. I just want to address it in a meticulous way. So Eileen, when you're in the trade, logic dictates you've done your research, you know what your limit is, you know what your risk is, and let the trade play out, right? There is another mentality of some great traders I used to work with over on MG years ago, and there's a mentality that some traders have that say, look, if you're in the trade and the expected outcome doesn't come within a reasonable time frame, odds are it's going to continue in the primary direction of the trend, just like you're saying right now. So what reasonable time frame means, Eileen, is very subjective. We want to keep our trading always rule-based, so we take out that objectivity part of it. So two things. I will typically take a trade, let it play out. I have my limit, I have my stop. If our analysis is sound, let the market play out. The only time I will jump out of a trade when it's sort of walking sideways or ahead of the stop or limit, Eileen, is when I get a clear trigger or indication to invalidate what I'm looking for. Meaning, to be quite frank with you, On this trade right here, if we just look at this objectively on a 5-minute chart, once we kind of cleared over this range right here, and you saw this thing pop through, that's an indication that you're seeing the momentum start to wane. Now that's not a good trigger because a second later, a minute, 5 minutes later, we broke below. But the tell on this wouldn't have been that trigger. It would have been the hold here at 40 rather. So the dip, hold at 40, and then recovery is the tell to me, hey, the broader upside momentum is still probably in play. So could I have closed this out maybe a little bit earlier, saved a couple of pips? Sure. I just don't want to encourage you guys getting too comfortable doing that because a lot of the times you will close out a position that would have been profitable just because you're looking too close at price action. So Eileen, I just want to premise that to everyone in the room because I think that's a big, big part of it. If you watch price action too close and you're in the trade, you don't want to start letting those emotions filter in. So objectively, let the trade play out. If there is a clear indication, a trigger in the opposite direction, the momentum profile is holding 40 and you're looking to be bearish, or it's holding 60 and you're looking to be bullish, in those types of trades, it might be a little bit more prudent to go ahead and bail. Yes, keep checking if the divergence in the forward triggers are going the direction of the chosen trade. And yes, I close out too early often. So I hope that offers some clarity on that. I hope you find that helpful. So moving right along with the Kiwi dollar, guys, I still, you're more than welcome. I still do like, the broader trade hasn't changed. None of the levels have changed. Our bearish invalidation is still 66.77. If you're holding shorts from earlier today, just note a basic trendline support has been a decent pivot here off the low right here. Support, support, support. You saw the pivot there, resistance, break, initial support. So as you come into this region, if you're holding shorts off the high, remember 26 pip ATR, take something off, stops to break even or better. If you get the break back below this, we'd look just to extend right into the continued opening range for the week. Remember, your key support and continuation of the turn here would be a break below 65.47, 65.50. All right. Any questions on Kiwi before we move off? Okay. Moving right along. I see some questions here. Yes, Mark, obviously wants to look at the euro dollar. We're definitely going to take a look at that. Euro key. I have two guys asking about euro key. Let me write that one down. We'll take a look at that as well. Okay. Next up on tap is the Aussie dollar. The swing side of things, we're still holding longs on that position. Here's what it looks like on the intraday chart. Just wanted to highlight this is the same setup that we presented earlier in the week. The levels hadn't changed, but an exceptionally clear weekly opening range, taking shape below 71.77 and above that 38.2 retracement at 70.83. Now you got some pretty dismal employment numbers out of Australia last night. Here's what the report looked like. We're expecting a gain of 13,000. We saw another contraction of 7,900. Unemployment expected to hold at 5.8, uptick to 6%. Now, as we always say, we always want to mask or look, rather, we always want to look what's going on with the broader participation rate as we see unemployment rate move, because gains in the participation rate will tend to put, artificial upward pressure. You didn't see any gains in the participation rate, and it did see an uptick. So that's definitely not a good sign. Also, if you drill down even deeper, part-time work, or full-time work rather, contracted by 40,000 last month, while part-time employment gained by 32. So you're seeing a very big, shift here from the previous month's data. Obviously, Aussie saw a really quick downturn on that release. The market faded it almost instantly, okay? The next 30-minute candle had already taken back more than half of the decline, and before the hour was over, we were almost back at unchanged. So this is a tell, okay, that the data was that dismal and you still got the market broadly holding the same range that we've been in. Tells you the underlying momentum is still to the upside. So I do think you possibly get another pullback here, try to get an opportunity to get back on the long side. Haven't taken any long since yesterday. The one long we took was during US trade right after the webinar here. You saw a nice trigger on a 5-minute chart. Stop was real tight, just above the opening range low for US, which is right there at like 71.07. And we eventually closed that out just ahead of this region. I think 71.68 is where I actually took the limit on it. So still looking for long scalps on this. A breach of this is going to really validate the continuation, or at least a little bit more of a broad rally. Such a scenario, guys. Couple things or a couple levels that you want to be taking note of. First of all is just basic trendline resistance off the December high. You're basically looking at like 72.16, 72.15, like right here. And then the median line, the sliding parallel, former support, now resistance, the 1618, the yearly open, and by tomorrow, heading into next week, that 200-day moving average will all be in this region at 72.70 to 72.80. So as far as the upside targets are concerned for Aussie, if we do break, I think they're exceptionally clear. Right now, you're still watching that resistance at 71.77. Not only is it that longer dated 618 fib, but it's also objectively the weekly opening range high. Okay, so aside from anything, putting all things constant, a topside break here would shift the focus to the upside, looking for a Friday high. All right, so you're pretty much spent on data for the remainder of the week here from Australia. Tomorrow's main event risk, guys, will be US CPI. This is really going to be sort of the cake for the closer of the week. You've heard the Fed continue to talk about inflation of the dual mandate being the laggard. You're seeing deflationary concerns cited across the globe by all these central banks. And certainly if we see inflation numbers tomorrow really disappoint, those interest rate expectations we've been following are likely to get kicked out even further, i.e. heavy for the dollar, bearish for the dollar. So we'll be looking for this release tomorrow morning at 8:30. The more important, the headline number that you want to pay attention to is going to be the core year on year. We're expecting a hold at 2.1%. A weaker print, look for some serious dollar weakness. A stronger print, you might not see the exact opposite reaction. You might not see the dollar rally per se, because there is still a weakness in broader risk assets that we're seeing, and it wouldn't necessarily, in my personal opinion, think that the dollar would necessarily just run off that. That said, could be the trigger to push the dollar into that final resistance that we were talking about at 12,123. So we want to be very mindful of where the dollar index is trading heading into that release tomorrow. Again, we're going to be looking at that core year-on-year number, seeing if we hold that 2.1%. On a weaker read for the Aussie specifically, I think that would be the push that we would need to get the blast off here through this resistance if it comes out at a weak number tomorrow. Any questions on Aussie before we move off? So watch that range, 71, 77, 70, 83. Hopefully we get a break this week of the weekly opening range, unless we go into next week holding that same range. Someone asking here, would you be willing to take shorts in the range? Yeah, so look, here's what I want to say. I talk about this all the time. I got no problem taking counter trend trades. In fact, if we just look at the Kiwi objectively, on this rally yesterday, who would have known that on this rally we had shorts on that made money? Now we eventually got stopped out on that last one, but we did take shorts off this play, right? Remember the previous night we had those 2 shorts that we took off that range just above key support. So if you want to play within the range, that's fine on a conviction trigger. The only thing, and we don't talk about it enough here, is you want to adjust your leverage, okay? How heavy you're taking the trade. So typically whenever I'm trading counter trend, or whenever I'm trading counter to the trend that the broader trend the market's trading in, just be nimble. So if you're trading X as a standard lot size per trade, you're trading half X. And that way, if the market does continue, or you get the sudden reversal to continue in the trend, you're not taking a big bath on that trade. So just keep that in mind. Okay. Moving right along. From The Aussie dollar, we want to talk about CAD yen real quick. I don't really have any plays on that either. That is just simply at still holding that same range. So here's what the CAD yen update looked like. We were looking for a break of the opening range for the week at 83.50. Key support at 81.88, which was a 38.2, but the actual open of the week was just below that. You saw that tag. Long story short, we're still holding this primary range for CAD yen. We'll be looking for a break of that. Here's the 30-minute looks like. So it's literally just ping pong, guys. 83.50. We'll call this 81.90 as support. We'll look for a break of that range. Now, inevitably, we would be looking for this break to be lower, is what the preferred trade on this one would be. Here's the broader trade on the daily chart of where we are. The broader range for 2016 is just the January calendar. Are we back? Sorry about that. So CAD yen, look for a break of this range. Again, sometimes you get those breaks and those fadeaways, and sometimes the market just sits there for a while. So a little bit disappointing that we got no plays on this week, but we will see. A nice wide range. I thought you can get a nice play on this with 43 pips as a quarter of the daily TR. So Aussie dollar, CAD yen, watch the range. That's all I can say. The weekly opening range is just really well defined on both of those. Euro dollar, we're still looking for long entries. And as we talked about yesterday, the euro dollar is actually heading right into that key sweet spot. If you guys remember here in the euro, we were talking yesterday about this sweet spot. Yesterday it was right here during the webinar at the median line of the current operative structure. Okay, you had a 618, extension. The former swing highs from December, the 200-day moving average, and they're all lined up in that region at 110.45, 110.58. You also have the median line, which is being tested right now. So I'm on the lookout for long triggers in the euro. If you take a look at what the broader euro dollar position looks like on the daily chart, here's what we're looking at. Okay, so broader uptrend. You saw a market change in momentum on the break that we saw this month. Remember, from the highs of last year in August, you saw multiple holds at 60, multiple breaks below 40. Hold at 60. Now you're starting to sort of straddle the 50. This is the first 60 breach that we've seen since that advance into the highs. So on the pullback here, this is the operative trigger. If that breaks down, you'd look for a much steeper recovery towards the lower median line parallel. Base case scenario, as we said earlier, our bullish invalidation level near term is still going to be at that 110.50, 110.46 level, that 200-day moving average, and that swing high in 618 extension. So I'll be looking here today if we get that drop on a decent trigger to the upside to jump into this one as we get closer and closer to that 1045 level. So now that we're sort of, any questions on the euro? I want to jump into that euro key trade that some of you are looking at. So the levels are unchanged on that. As a quick reminder, I see some new faces in the room. If you do have, or if you want to take a snapshot of any charts that you see presented, there's a camera button in the top right-hand corner of your GoToWebinar screen. Just go ahead and click on that if you need to reference these charts later on the day. But Mark, for you, Euro Kiwi, looking to buy around 166.60, he says. Let's take a look at Euro Ki. Yeah, it's been a real tight range on this one. A lot of back and forth. The one thing I do love about Euro Keys from a near-term strategy standpoint, you have a very wide ATR, so on a daily basis, you got plenty of room to sort of knock out those swings. Near term, here's your weekly open. Let's do some on-the-fly analysis here for Mark and Eileen. Okay, so the monthly low day close comes in at 66.37, and you have the 200-day moving average coming in at 65.66. So 2 levels of support I'd be looking for. Here's your trigger on the daily chart. You have a support trigger pending off the lows from December. And the weekly opening range is pretty well defined. I don't want to stress this retracement too much because we've made a couple of rallies in between already. In fact, let me just redo this for you right now. Okay. Okay, just want to see if we're seeing any parallels here. Give guidance on this slope. All right, so this is what I would say on this, guys. I like where you're looking, Mark, as far as a possible entry. 66.60 per se is just basically the 786 retracement. So 2 levels I'd look on either side of that before. I'm not sure if we get quite down there. Is A, you're at the weekly opening range. So personally, if you get a break sub 67, you're probably going to see more than just a 40 pip run on a pair like this, especially now that we've tested it twice with some pretty clear conviction reversals off it. So on a downside break, you probably see a little bit more of a concerted run towards the figure there, my humble opinion. Second of all, as far as the daily chart's concerned, 65.50 would actually be a really interesting area for me. The 50% retracement of the broader advance off the entire December low. And then you got a lot of there with the moving averages. And I'm not a big moving average guy, but guess what, guys? When the market's there and those moving averages converge on technical features we're watching, really, really nice. So here you got the 50% retracement, you got the 200-day moving average 65.65, and then the 100-day moving average right on 65.25. So 2 levels I'd look just ahead of that, and then just below that 66.60 region you're looking for, I think would be a possible nice entry on this one. And objectively, don't forget, objectively on this one, Mark, 65.25, my man, is just the opening range low for the month, that 50% retracement. And the swing low is from late last month. Make sense? He says, yeah, that's good on this pair, 100 pips, some nice back and forth on dollar CAD as well. Right, maybe if you want to go long, then it's now maybe. Cool talk. Thank you. You're more than welcome on that one, Mark. Like I said, just watch those 2 levels right there. I got a question here from Dave. That was you with the dollar CAD. Nice back and forth on dollar CAD if you enjoy the M1. We'll definitely take a look at dollar CAD in a moment. Any questions on Euro Key? This was for Mark and Eileen. Both of you are looking at this trade. Does that make sense, guys? Very, very clean opening range. Again, on trades like these, guys, there's nothing wrong with playing the ranges. We just want to know where the broader trade is. And this is going to be, like I said, the key support I'd be looking at least on a pullback here for Euro Key. Broadly speaking, I do like the upside, both from the Euro strength standpoint with our singular opinion on the Euro, and both on the Kiwi, on the Kiwi short side. Eileen said, took the long too early on it last night on Euro Key. Yeah. Well, I mean, the Euro still kind of was doing its own thing, right, Eileen? It was kind of just sinking lower. Here's what Euro Oz looks like, and I'm just taking a look at this because this is a pair that I'm very interested in trading, and actually this was we were really heavy on this one last week. Haven't really touched on it this week just because here's what the intraday chart looks like. The opening range didn't really give us much conviction. You kind of just continued to sink. This is just a pitchfork we tacked on yesterday here, if you remember. Seems to be holding things rather well. I just don't like pressing a short down here, and as far as trying to call along, while you are getting some divergence on this low, it's not really a clear-cut support trigger there, or support in general, for me to try to trade against. So I'm looking for some clarity on this one, but Euro Oz is another one I'd like to play a little bit more on a range-bound type of move. So on a long break out of this, I'd be looking just to target the weekly high and then turn back down. Remember, our bias is pretty much constructive on Aussie dollar and Euro dollar. So for Euro Oz, we shouldn't be expecting too many divergent breaks in one direction. I think you'll get a little bit more back and forth here as well. Moving right along to, let's jump into dollar CAD. I also want to cover dollar Swiss, which has just been on a steady ML formation to the upside. But dollar CAD looks like this. And of course, swing side of trades are also still holding that short on dollar CAD, targeting the initial target for me is 35.40 is the 618. But just ahead of that, I do want to point out that 100-day moving average and basic trendline support, channel support, dating back to that low that you made, what was that, in May of last year. That is dead on with the 100-day moving average here. Okay, right around like 135.96, essentially 136 for dollar CAD. Stop is still at 66.90, if I'm not mistaken, for the swing side. Let me just, don't want to quote you wrong. Jamie has stop still 66.88. Same level. Here's what the intraday chart looks like for dollar CAD. Not really an appetizing piece for me. We looked at this trend line yesterday. We were sort of pivoting right off as resistance, right off as support. I don't know what that is right now. From an intraday level, it is giving you a 42 pip quarterly ATR. But guys, on a trade like CAD, I'd rather treat it as we are on the swing side of things. I'm not too keen on getting in and out of the CAD, of the dollar CAD pair specifically at this point just yet. So if you're holding those shorts, everything looks good on that. I'd actually probably bring down my stop to that swing high if we do clear below that near-term support, 36.33, and then that 36 region is going to be the real key level of support that we're going to want to take a focus on right here. Questions on the loonie. Now, dollar CAD says, on dollar CAD, why view it as a swing? Because the trade is a lot more one directional. So Eileen, we want to recognize what pairs are going to benefit us the most. The entire objective of near-term trading or intraday trading is to be able to play the same range on multiple occasions. So if the market is giving you a range like this, right, for a week, where a long long position for a swing guy he's going to sit in this for a whole week to gain just this 50 pip range. Okay. Now he's looking for the broader stretch, but for us, we can play this long 4 times within this 50 pip range and squeeze out 100, 200 pips while we're sitting there. On a trade like this now, Eileen, where it's one directional, you're not getting much pullback. So when you get the position in, you don't want to bail on it. You kind of just want to hold it. Same thing on the way down now. There hasn't been much back and forth. This is too tight for me again. Now that we've sort of just been swinging lower, if I'm holding a short, I kind of just want to hold it and look for the swing. I don't want to get out and look for re-entry because you're not really getting that on this move. Does that make sense? How we determine how we want to attack the trade is basically where it is in trend. Uh, that dollar CAD is at support. Why not look for longs because of the fundies? So it's not quite at support yet. Like I said, 36 would be a nice area of where we could get a rebound. But aside from this one jump here, Eileen, how many long positions could we have squeezed out this week? This probably would have gotten stopped out on that. This probably would have gotten stopped out on that as well. Hell, even if you took this trigger right here to the upside, you're not even at your 40 pip ATR yet. So instead of trying to fight the long side, if you catch a decent short from a nice position, you want to just hold on to it. Does that make sense? And as far as calling a long on this, Eileen, not interested. I'm not ever trying to call a low, nor am I trying to, catch a falling knife. If we come into support and I get some settling here in a near-term long trigger, that's just a scalp against the lows. But like I said, it's a pretty clear-cut, identifiable trade. I'd rather just be in the direction of the trend in this. Whereas Aussie, we just looked at that earlier. This is a much more readily identifiable range I'd rather trade back and forth, no problem. Although, to be honest with you, as I noted in yesterday's piece, I'd still rather be buying pullbacks within this range, but you get the picture. I see those details now. Thanks. Makes sense. All right. Right on. Great question. Great question. I get that a lot, and especially when I'm tweeting out, I'll be like, hey, Euro's coming into near-term support. Automatically, you get those guys saying, so are we going to take a long? It's not always just because we're at support doesn't mean you want to take the long. You want to know what the broader trend is, and I'd rather be scalping in that direction. Okay, so moving right along, there's no other questions on Aussie. Sterling, kind of a trickster. Notorious for the throw over, notorious for the break and reverse. And here's we were talking about this yesterday. And it's exactly what happened. We were talking about 43, the conviction, confluence you have there, the 618 retracement of the advance, the median line and the sliding parallel of the current operative formation off last year's highs. And they both kind of converged around this 43 handle. If we closed below, the risk was for a real, more significant drop. You closed just below. Okay, just below. I think the low is like 42.84, if I'm not mistaken. Yes, the close was 42.85, and then we opened up Asia trade and kind of just broke the opening range right to the upside. So here's that near-term resistance. This was the long that we were talking about yesterday that I would have liked to take. No triggers really gave out throughout the course of the day. Again, missing some trades here in overnight as Europeans still giving some really nice triggers to the upside. If you're holding long exposure, again, at this point, I'd be out 3/4 of the trade, stops at break even. This is going to be the near-term bearish invalidation level. If we do pop through this, and we said this yesterday, huge pivot in price, 618 extension off the high, the weekly lows that we made last week. If we pop through this, look for a rally right back towards that basic trendline resistance to the upside. Don't have any positions, unfortunately, on the pound. Didn't catch that break in overnight trade, but I think we're pretty clear as far as the levels we want to trade. Your key support still 42.58, 42.47. Okay, it's the monthly open. Don't forget, we came right into it yesterday and reversed. And a break above this region would be looking to buy pullbacks towards essentially 45 or so, basic trendline resistance. I've been saying you need to train Siri to trade sterling. Maybe just algos get the throwback trades. Oh, yeah. I mean, it's funny. My good buddy Christian Kerr, if you guys know him from Daily FX, we're big sterling traders, me and him, and we always talk about false triggers. Every time I want to get into a position, hey, is this the throw over or is this the real deal? On this, I would have loved to really, if we had closed above 43 for me, I would have been on the lookout for long triggers. But once I saw that close below, kind of didn't pay attention. Should have. because the reversal was really nice here. Any questions on pound? Again, no more event risk here from the UK. You're just going to want to focus on tomorrow's CPI data in the US. All right, so dollar Swiss is next. Here's what it looked like earlier in the week. So here's what dollar Swiss looked like yesterday, or a day before yesterday, and we were holding within the confines of this median line formation. Remember that 38.2 offered some nice resistance. We quickly dropped below, and the trigger gave to the upside. We talked about that yesterday. This thing was stretching towards that 100 DMA, didn't quite make it to that 50% retracement just yet, but we're almost there. Hey, almost there now. 99.58, currently trading at 99.56. And that's going to be the 50% retracement of the decline. Okay. Look for this 50% at 99.59. Interim support 98.88. And at this point, guys, again, remember, I keep these retracements in gray because we're just moving along with price. These don't matter right now. Once we get a concerted high, a turn in price, a momentum break in momentum, then we'll really be able to stress this retracement more. As it stands right now, when we put in that high, we'll just tack it to the new high. So don't mind these levels, but when we do, we'll want to see what the bearish invalidation level is. It's going to be the 38.2, wherever it converges on this basic median line formation off the lows here. There's a soft target higher at 99.88, like I said. The 618 comes in at parity 28, and this was the level that we talked about yesterday, sort of like the sweet spot. If it was to get a rally into this region, I think that's a beautiful beautiful rather short entry for a possible move lower. But as it stands right now, you're testing that initial resistance range. Keep in mind that this is still also posting some divergence here. Price action making a higher high, oscillator making a lower high. It's the third divergent point within this rally. So momentum is starting to get a little tired here to the upside. Wouldn't want to be looking for any fresh exposure in the longs from here. If you're holding longs, 99.88 or 99.58 rather, first level, you want to start peeling some of those off. Subsequent targets as labeled here, 99.88 and parity 28. Eileen says, well, sterling was sideways for so long, it could have broken either way. It could have. And for me, I was looking, if it closed below yesterday, 143 on a more, I mean, for me, when I saw that close, I was like, all right, well, pound is probably going to just shoot to hell from here. It is really, this pivot has been pretty critical. And I think we're pretty clear as far as the divergence or as far as the broader directional trend. But you saw, again, classic sterling moves. Eurocat, still waiting for the long, says Dave Freeze. Oh, so we talked about this yesterday. Was that you, Dave, that was looking at this yesterday? You actually got me looking at this after the webinar. Here's what the intraday charts look like. Oh, I also want to talk about dollar CNY when I get a chance, but Eurocad looks like this. So here's the setup I was kind of keeping in my mind yesterday. After the webinar, I kind of threw this around. I was thinking about highlighting this setup, but I didn't really want to see, or I guess what I wanted to see was a more concerted break of the objective opening range. So you see that failed in the upside, a basic trendline resistance here, just tagging those two highs, gives us some structure to the decline. And certainly the break below this confluence support, you're looking for the stretch low for February. That's 5109, 5110. But the 50, the entire advance comes in at 5060. And guess what? That level converges on the median line couple of hours here. So I think, I mean, the levels are pretty clear. If we're looking for long exposures on a rebound, Dave, these are sort of the initial levels I'd be looking for. I do like the rebound idea for the Euro CAD. I don't want to necessarily try to call a low on this. So if we do get a drop into this corner or into this major key support, look for an upside trigger to give us that play. And again, let's bring it right up right now, Euro CAD. Okay, so you're getting some divergence along those lows. Same gig here. Not much of a trigger here that we can set on the 1 minute. And we're trading near the range lows, so that's pretty good. You can see here for the Tokyo trade session, guys, for example, and this is a great indicator you can get from MarketScope, guys. It's called trade sessions, and all it does is it highlights the high and low for every session around the globe. But if we look at this, the Tokyo and Sydney opening ranges were pretty much preserved into the close. You saw a break of that low in London. That's what gave us the drawdown. But here we are again. I'd be looking for that 5110, 5060 for possible long exposure here on EuroCAD. Still probably have some more to go on this before it turns, Dave. But I would like to be on the rebound also on this one. And again, kind of look at the parallels that we're seeing across the market, right? Kind of lines up almost exactly with what we're looking at the euro dollar. Sort of looking for the euro dollar to drop into that sweet spot right there, 1058, 1045 for possible long entry as well. So I'm with you on that. All right, we covered dollar index, Swissy we talked about too, dollar CNY. I just wanted to touch on this briefly. Daily FX is we got a couple of new guys there that are really more focused, or new gals, I should say, that are really more focused on the story over there in China. I just wanted to bring this chart up and show you kind of where we were on that exchange. Where are you? There you are. And just wanted to note this key support that we ran into yesterday. So a broad ML formation. This is from the August high that we saw, the low that he made in, what was that, October, and then the subsequent high that he made in January. You can see that median line almost on a close basis, almost right on the dot, caught that rebound. Whoops. So what does it mean from here? Not necessarily going to be a trade setup per se, but we're holding within the confines of this. A basic retracement for a 236 would take you into, what is that, 65, 654.90, just shy of 655. And a downside break here has some serious implications because you have the 100-day moving average, the 618 retracement, and give you targets at 64.50. More importantly, you'd be looking for that swing high, 786, channel support. That's all the way down here at 64.80, or 640.80, 641. So pretty big region here. Again, knowing China, I doubt that they're going to want to really press the let it drop quite that significantly all at once, but those are the levels to know as far as this CNH trade is concerned. It's been getting a lot more attention over the last couple of days. The carry cost is insane for CNY. I completely agree with you, Dave. That's why I don't currently get involved with it, but when there's a setup or when you're on a key level, you just want to be very mindful of it. He says, I like the long-term play, but can't justify the costs too manipulated for smaller time frames for me. 100% right. Well, let me take a step back. The manipulation of the currency in near-term trading isn't really the bigger issue. I think the fact that it's manipulated currency on a whole makes trend identification harder because if conditions warrant, wherever you are in the trend, they could just come in and do whatever the hell they want. So yeah, the risk is definitely there. But the carry cost is pretty intense, I know. SPX also, just wanted to point out the resistance that we were talking about. You might have seen Jamie post a chart earlier today on this trade. Basically, a sliding parallel extending off the December high is basically where we are right now. Also note the high day close for the month is essentially what we peaked at just now. So a breach above this region, and you're essentially looking for a run on the 50% retracement of the entire decline off the November highs, rather. That's like 1963. Right now, you are testing the monthly open, sliding parallel resistance, and again, breach the upside, you look in 1963, risk is for a pullback from here. What targets for Eurodollar for later longs? Eileen, so you're talking about if we take the long on that drop, where are we looking for the upside? So the levels are not going to be any different. If we get the drop into this, your first level to the upside of key resistance and the near-term bearish invalidation level, if we drop that low, is going to be right here, 1120. Okay, pretty readily identifiable pivot in price, a longer dated key 618 retracement. And again, if we make it that low, a breach above that would necessitate a push through the upper median line parallel. And at that point, you'd be kind of playing that breakout play, Eileen. I think this would be a nice entry. If we get the long trigger, I really do like a sort of a more breakout play to the upside. Remember, the broader trade for Euro, at least for me, is still looking for a nice push higher here. So also, just looking at this, guys, and taking Elliott into account, I know I'm not really huge on Elliott, neither is Jamie at this point in our careers, but certainly when the wave count is readily identifiable and it's right staring you at the face, guys, can give you conviction on the directional bias at least. And here on this last advance, looks to me like a basic 1, 2, 3, 4, 5. So on a correctionary move, you see a rebound here. Yeah, we'll play the rebound. You'd look for a new low after that, but inevitably, you'd look for the broader continuation for the uptrend. So even if we get that rebound, Eileen, 120 would be your first target. If you get a break beyond that, maybe you see 111.90. I'd be looking for another pullback from there, and then inevitably we'd be looking to resume the broader uptrend. All right, so if there are no other questions, or if you do have any last-minute questions, guys, feel free to throw them on the message board. It's been a quiet 24 hours. Hopefully we can get a little bit more action. The swing side of trades, you're still in Aussie, CAD, and Kiwi on that side. The Eurodollar, we're looking for entry, CAD short. If we do get a pop higher for re-entry, I'd actually look for an add to that position. But certainly at this point, dollar CAD's coming to a very interesting area. I want to see what happens at 30, essentially that 36, 34, but 37 at this point. Excuse me, at 36 at this point is going to be pretty major, pretty major. In previous sessions, you mentioned following monthly or weekly highs that if trend fails below, the likely move is to the highs. That theory or a name on that concept, David, I'm not sure if you're referring to opening ranges, I think is what you're talking about. And that's what the theory is. You can find more information on that type of trading, David, in a book called The Logical Trader by Mark Fisher. Great piece. He really highlights the use of opening ranges as it pertains to the commodity pits, where he really sort of maximized the use of that strategy. But basically, if you look at price action, David, the theory suggests or reveals that markets tend to open and close on the extremes. Meaning, if we're in an uptrend, then you'll typically see the week or the month show the low early in the month and the high late in the month. If we're in a concerted downtrend, you'll see that the high is made early in the month and typically your low is made late in the month. And to ascertain this, you look at the opening ranges. So David, when we're talking about the opening ranges for the month, you're talking about the first week, the first 7 to 10 days. Don't stress the time, more so stress price action. And a really good example of an opening range for the this trade, for example, just whatever chart's on the screen, is dollar CAD. You saw that for the December opening range heading into the 4th, and the next week, the 7th, saw a clear break of the first week's opening range. You put a high pretty late in the month on the 20th there before pulling back slightly. Another trade that has pretty decent opening ranges. Let's see what had a good opening range recently. Where's Aussie? Comblock typically has really nice opening ranges. I'll tell you what doesn't play well with opening ranges, dollar yen. It's notorious. If you wait for the opening range there, you'll be waiting all week. This is an example of a decent opening range typically on the euro dollar. Here's your weekly open. All right. So David, you set a high early in the week. Tuesday, you set a low. You test that high, it fails, or you test that high and it holds. Heading into Wednesday midweek, you saw the break to the upside. That keeps you bullish heading towards or looking for a late week high. Doesn't mean you'll necessarily close at the high, David, but you're looking for a late week high. And certainly on this week, we put a high for the euro dollar, for the Aussie dollar right on Friday. Okay, now we can use this same theory, David, on a monthly prospect, on a weekly prospect, on a hourly prospect. So when we're scalping, okay, when we're looking for near-term trades, typically the hour will set a high low. You look for a break of that hour to give you a directional trend, or you look for the break of that range to give you a directional trend. Here is a 5 o'clock open, okay? You set a low, you try to make a run at the highs, you failed. You tested the low, you saw a rebound. Final break happened at 5:15, 16 minutes into the 5 o'clock hour. You look for the trade to close the 5 o'clock hour near the lows. Right ahead of 6, you're at the lows. Okay, so we can do this on all different time frames. And for the weekly time frame, or for the session time frame rather, that's where the 5-minute chart comes in, right? So let's see. This is a bad example because last night you never saw a break of it, but here's your Sydney open. Sydney sets a high, sets a low. You look for a break of this range. If we had broken this range to the downside, you'd look for Sydney to close the session near the lows. Here's today's London opening range. Your London open. Low was at 52. The high was at 52.50. You're looking for a break of that range. It happened a few hours into London trade. Look for the trade to close London near the lows. And that's what we're doing now. Dave, does that help? Does that make sense? So you're basically looking for the market to set a high, low in a preconceived time frame. You'll look for a break of that range to validate your directional bias. Now, one thing I just want to note is that opening ranges are a way of validating bias. It's not necessarily going to be a trade strategy on itself, a standalone. Meaning, I'm not going to, be of the mindset to tell you guys to be comfortable with, oh, I broke the highs of the opening range, let me get long at the highs. I'm never going to be able to, justify that kind of strategy. But it gives us the directional bias. We broke to the upside, good. I'm looking for a late week high, looking for a pullback to get long. So it's very, very important that we just identify that the opening ranges are there to give us conviction on the bias, not the trigger to jump into the position. All right. Dave said, yes, excellent. Sorry to go off on a tangent there, but really important that we kind of get that straight, David. And again, if you want more background information on that, The Logical Trader by Mark Fisher, I think is a must read. Dave says, I know not your area, but any insight on why CAD, which was lockstep with crude into January, has lost that correlation of late? Dave, you're right. It's not my area, and I do watch those correlations carefully just to see when the correlations are tight or significant or when they're not. The reason they're diverging, Dave, is something I don't even spend time thinking about. Doesn't matter to me. I bring up the correlation to see where we're standing right now. Are they moving in lockstep or not? And that's it. There's a whole host of reasons of why you could be seeing that divergence happens. One of the main reasons, Dave, if you want to talk about it from an economic standpoint, one of the main reasons you see CAD start to break correlation with crude is on the stance of monetary policy. So if crude is on the way down and they see further losses expected and the CAD is sort of following that, guess what? if the BOC comes out and there's now a look, or if the BOC is coming out now and we're looking at interest rate expectations starting to move higher on the long end of the curve, you'll see the CAD start to put a base in, even if crude prices are falling. So don't stress the reason so much. Rather know where the market is. Are we in a market right now where those correlations are significant enough for me to be able to help, use them to help me ascertain bias? Eileen says, great discussions, like the tangents. I like the tangents. All good. See you next week. Cheers, Eileen. Dave said, any efficacy with correlation rate of change, i.e. the RSI break of the correlation. Dave, to be quite frank with you, my man, I haven't run studies on that. When we're looking, just to put things in perspective, when we're looking for these triggers in momentum, we're only looking for a change in behavior for the relative strength, a shift, okay, or a graphically identifiable change in behavior for the momentum. If you're going to track change in correlation and try to use triggers on that, to be quite frank, I've never actually tried it, Dave, and I'm not sure it would offer too much of a tell. It might tell you when the correlation is starting to weaken at accelerated rate, or if it's starting to strengthen at accelerated rate. But I don't know how I'd effectively use that in a strategy. It'd be something interesting to take a look at, Dave. But more so, I just want to know what the correlation is in the present. Is that correlation building stronger, or is it a weakening and they're diverging apart? All right, great question, Dave. David Fernandez, same with you. Great questions, guys. All right, so I'm over on time. If there's nothing else on tap, we'll go ahead and wrap it up here. Again, keep in mind, tomorrow's event risk for CPI, guys, is going to be the biggest player here for all the dollar crosses that we've been following all week long. So maybe that'll be the event risk needed to get that pop in Aussie dollar, to get that drop in euro, and then the subsequent rebound. So we'll be looking for that data tomorrow morning, 8:30 Eastern. We'll keep you updated on SB Squawk. Till next week, best of luck trading. We'll see you then. Cheers, guys.